Hi, for those of you that don't know me, my name is Brad Hines. I'm a professional options trader for a living. So today is July 19th, and as you may know, Netflix earnings are coming out later this afternoon. Yesterday, I wrote a put option on Netflix for $131. If you don't know, what that means is that I've taken on the obligation that if by this Friday, because the contract's for the 22nd, if Netflix is to drop to 131 or below, then I'm obligated to buy, in this case, 100 shares because I wrote one contract. How did I pick $131? What's the significance of that? I used a method called the Implied Straddle. The Implied Straddle is a concept in the options world that the options chain, so the prices that you see listed for given strike prices, what the options are going for, the market for those often dictates what will happen in the stock market. The options market in turn acts back in on the stock market. So the implied straddle is a calculation that can help predict what's going to happen with this stock based on any kind of binary event, typically earnings, but it can also be things like FDA releases or an announcement that's pending that's going to come out. It's not a foolproof method, but it is a good one. So again, you're using the options markets, what the given bid and ask is on a specific price to try to predict what's going to happen to the stock. So the implied straddle is taking the at-the-money option of the most near-dated contract. So in this case, earnings is today, July 19th. The contract is for the 22nd. Yesterday when I checked that, the at-the-money price was around $191. And at $191 on both the put side and on the call side, it was about 15 bucks. I think it was $14.90 to be exact, to purchase one of those contracts, to purchase a call or to purchase a put. And that, by the way, was averaging the bid and the ask. So maybe the bid is $14.80 and then the ask is $15.20. So we just call that $15 for the sake of keeping it easy. So I average those for both sides. And then you add those two figures that you get from each together, and then you're going to multiply that by 0.85. Often to be conservative, I'll just multiply it by 1, and then that builds in a safety pad, or I'll do the 0.85 and I will just add in the safety pad on my own. So I actually did a big safety pad here, which sort of implies that I think that there might be a surprise on this earnings. That's just sort of a gut feeling. I haven't read anything to really back that up. I just know that when it's very talked about like this, that's always a possibility. So we will see what happens later today when the earnings come out. I went very conservative, so I should have gone 30 below 190, which would have been in the 150s or 160s. I did double the implied straddle, and I went all the way down to $131. So we will see what happens this afternoon. Oh yeah, one last thing. Even though the contract goes until Friday, I'll probably know well ahead of time whether or not I was successful, because what will happen is after the event, there's no more expectations. There's no more feeling of what is going to happen. And this drops the volatility drastically, which, if you know, in the Black-Scholes model, which is what determines the value of an options contract, once volatility comes down, the option price comes down. Where I'm the seller, there's a good chance that even if the earnings are negative and the stock drops to, say, 150, what will happen is the volatility will be so low that the contract will be worth maybe $10, and I'll have got a 90% gain on the contract. I can buy it back for $10, and then instead of making 120, I'll make 110, and then that way I won't have to wait all the way until Friday. I'll know that I made a profit by Wednesday, and I won't need to risk the additional day or two on the contract for a lousy $10. So that's just one last thing I wanted to say.